Welcome to another episode of HDFC Life Presents Live Sessions partnered by ET Now. Life insurance is often described as a business of managing risk. But in today's rapidly changing environment, shaped by shifting demographics, regulatory developments, and evolving customer expectations, risk management is not just a safeguard, it's also a driver of innovation and growth. To unpack this very crucial balance, we're joined today by three leaders who bring diverse perspectives. Mr. Vivek Jalan, MD, Insurance Consulting and Technology, Willis Towers Watson, India. Mr. Srinivas Rao, MD, Life and Health, Southeast Asia and Asia, Munich Re. And finally, Mr. Neeraj Shah, ED and Chief Financial Officer at HDFC Life. Together, we'll explore how India's life insurance sector can align growth with resilience and what it will take to prepare for the future of protection. Gentlemen, all of you, thank you so much for taking the time out and speaking with us today. Neeraj, if I could start off with you. Traditionally, life insurance is always looked as a financial tool, whereas it's really all about risk management, right? Tell me, how is it that, from HDFC Life's perspective, do you see the fundamental relevance of life insurance products into a customer's daily life?
Absolutely. Let's start with the customer and the daily life. What are we really all setting out to do?
Yeah.
We want to improve our standard of living. We have aspirations for ourselves, for our children, and we have aims to the second part of our life once we have finished, the more active part in terms of earning. So across each of these, we have our goals and aspirations. Where life insurance comes in more in terms of ensuring that you're on that path. And in case there are any impediments to that, can there be any sort of a transfer of risk from the family and the individual to another entity? So that's where life insurance comes in. So if you just think about it, what is the going assumption is that I'll continue earning, I'll be healthy, and I'll be able to enjoy my post-retirement life. Where life insurance comes in as a support is in case of, let's say, an event, in the context of an absolute event, a death of a family member who's an earning member, that can cause a lot of disruption to the family. And it's obviously unplanned whenever it does happen. That is something where one of the key risks, which we call mortality risk, which gets transferred from the family to an entity, is one of the key aspects. The second is, if I have to earn, obviously I have to be healthy. So if I'm going to fall sick, I'm not going to be able to earn and realize all my aspirations. So that's the other risk of what we call the morbidity risk, where the insurance company comes in and helps the entity manage that. Third is in terms of, will I outlive my savings? Because longevity is increasing. How do I get to a stage where I always have enough to take care of my and my family requirements? So longevity risk transfer is another tool which an insurance company can help with. And lastly, we all have certain thought processes in terms of how my savings pool will grow. But there's always variability in that. So how can I take care of that variability of, let's say, interest rate risk? That's another area where life insurance comes in. So for every aspiration and goal, there could be events which could come in the way of that. That's where life insurance comes in. At a very macro level, this is at a household or a family level, but at a macro level, India is one of the countries with the highest protection gaps. Longevity is increasing. Pension assets as a percentage of GDP is one of the lowest, given where we are as a country. And also in terms of the number of people above the age of 60 is going to be 3 times what we have today in the next 25 years. So keeping all of this in mind, it's a very important aspect that the life insurance companies are able to address from a household and from a family standpoint.
Mr. Rao, from a reinsurer's hat, and exactly from what Neeraj said, that right now you have a larger pool below the age of 30, the demographics are in our favor, and the next 2 decades, all of us will need higher amounts of insurance, and the entire demographics system would change. How is it that you actually cash in on or capture the entire growth story of India's demographics?
So you rightly mentioned about the demographic shift. I think 65% of India's population is less than 35 years of age. And these are the people that you typically look for in terms of insuring. And they would be the people who would go beyond 30, 35. And this is a segment which needs the insurance most. So as a reinsurer, we are committed to this market. And there are few things that are happening that enables us to focus a lot more on the growth. One is the legislative change. Government is thinking of changing the capital requirements and the FDI on insurance and reinsurance. So more players are likely to come into the Indian market that would propel the growth further. There is also this regulatory change around risk-based capital coming in. That would make capital a lot more appropriate to the risks that the insurers and reinsurers write. And thereafter, you are looking at a change in the accounting regime, which is equivalent to the IFRS 17. And that would also bring about some transparency and making sure that the insurance companies are recognizing the profits in a more transparent way. So I would believe the changes that are happening on the demographic side, the legislative and the regulatory side all propels in terms of the growth. But what are we doing as a reinsurer in terms of capturing this growth? One, we are trying to make sure that we are looking to partner with insurance companies like HDFC Life, which are far more governed in a more appropriate way. See, there are insurance companies, and one of the regulatory changes that we have to talk about is the risk-based supervision that would differentiate companies based on the governance structures. So I think we would be looking to partner a lot more actively with companies like HDFC Life and some similar organizations and provide capacity to products that are more appropriate and are priced and underwritten in a suitable way.
Right. Mr. Jalan, that's the point, right? That the opportunity is so large, but the penetration is so low right now. And like Mr. Rao was saying, there is so much to do. So how is it that you cash in on this opportunity, which can be so sizable in the days to come or times to come?
Yeah. So if you look at what Neeraj was talking about and Mr. Roy is talking about, the policyholders are putting a lot of their own hard-earned money as their own risk management tool to the insurance companies. So that becomes an important thing. From that perspective, they are giving their money. So at the same time now, the insurance companies need to ensure that they are managing the risk appropriately for them. Because whenever the contingent event happens, the insurance company should be able to pay it back to them. So the risk management thing becomes very, very important for the insurance company. And if we look at it from the perspective of the insurance companies, especially in the Indian market, the life insurance industry has been pretty resilient in terms of risk management and the balance sheet management as well. Because I give an example. Whenever any friend of mine asks me which insurance company they should buy a policy from, I always say, if your disclosures are right, if you're filling everything that is right and you're not hiding anything from the insurance company, don't worry, you'll be paid back. That's a way.
Any is good.
Any is good. So the important thing from their perspective is the regulatory framework in India ensures that the life insurance companies are pretty solvent at all times. Another thing, what we have also seen is the risk management framework. The companies are having a pretty much, they're evolving. I would say we are not as close to a lot of other global market in terms of which are evolved from the risk management perspective, but we are going there because India, if you'll see, it's only 25-year-old industry. It's like pretty nascent, I would say. It's not like we have evolved to an extent which is large. But we are moving there. We are learning from other market and trying to move there in that manner.
And Neeraj, I guess that's where responsibilities such as your organization comes into being, right? Because we all know that business has scale and we all know that eventually the business has to be profitable. But the long-term risk management and the kind of responsibility that you have towards your insurers, you need to see that, everything is balanced and it doesn't get compromised. That trust that any policy holder sort of entrusts with you.
No, absolutely. So that's where you need to really understand the role of risk management. It is not at loggerheads with your growth aspirations. Yeah. If at all, it is only complementary and in fact will only help you in sustainable long-term growth. So from that perspective, it's important to have a fairly good balance in terms of how you drive business, whether it's in terms of growth, profitability, risk management, quality of business. All of these are internal objectives. But if you just think about it from a customer perspective, it's very, very important that the starting point of where the business is really coming from is met, which is in terms of ensuring that every promise that you make is upheld. And that is only possible if your business practices are sustainable. And in terms of growth, where can it come from? I mean, it comes from new opportunities, it comes from new customer segments, new markets, and innovation. Risk management sits as a fulcrum or a foundation to each of these aspects. And that's where the role becomes more and more clear as you go deeper into India, for example. Risk management that works in, let's say, larger cities, for a salaried customer will not work in some of the other markets as you go. So can you evolve to be able to do that and still do justice to the opportunity? So that's important. How do you use data? How do you use technology? And the very key aspects of diversification on distribution, balance in product portfolio, all of these things are inherent to support the growth objective from an insurance company perspective.
And Mr. Rao, that's where your job also comes in, right? To try and understand, like you were saying, what suits customer A, even within tier 1, is not the same as B and C in tier 2 and so on and so forth.
I think accurately pricing is very, very important. In the past, the portfolio mix was slightly different, and as we cater to different segments now, the future portfolio is going to be of different constituents. How do we accurately price, and is it possible to accurately price? That's something we would have to think very carefully, both insurance companies and as those we are supporting the insurance companies, the reinsurers, we have to think of very carefully. Accurately pricing is difficult. I would say actuaries have never been able to price accurately. What actuaries have been trained to do is to price it at such levels that they don't make losses. But it's also important to recognize there may be scenarios where pricing or even understanding the risks is not so very easy. The latest example that we can think of is the COVID scenario, where the risks were very different, something that nobody has ever known about. How do you assess the risks and how do you actually price them? And it is in these type of situations that you tap into the global expertise, look for regions where the pandemics may have happened, or any other event which you are dealing with for the first time in India. Global reinsurers like Munich Re tap into the experiences elsewhere, and then they try to provide support to the insurance companies. Without being immodest, I think we can say that there were few reinsurers like Munich Re who were willing to support the insurance industry when the need was the most, like during COVID. It's also important to recognize if we don't price it appropriately, then huge losses can happen. And unlike in a transactional commodity products where you can have very short duration coverages, these are long-term coverages, 30, 40 years you guarantee. So it's not important to understand what is the risk right now. You need to even evaluate what the future risks are likely to be. And it is in that context that you need to have a foresight, not just of what is the current medical situation. You need to even think of the larger context of the country. So for example, if we think of tier 1, tier 2, tier 3, you know that tier 1 is perhaps a lot better in terms of medical infrastructure. But tier 2, tier 3 today, they experience heavier mortality when compared to the tier 1s. Will it remain this way for the next 30 years? Or do we anticipate things to change over time? This is an important consideration that insurers and reinsurers have to do in terms of the future. And that is where reinsurers with experience, we try to help the insurance companies actually forecasting what could be the improvements in mortality, not just because of medical advancements, but also because of infrastructure changes. So accurately pricing reflects so many things. What we need to do is to make sure that we are not being excessively aggressive and do not own up for things that we cannot control.
The other point, of course, also is, as not just India evolves further, but as Bharat evolves to India, your tier 2 to 3 to 5 cohorts, they have evolving customer profile, and perhaps the delta of change is much higher than what tier 1 cities are currently at. How is it that you're also adapting to the risk assessment framework, while, of course, maintaining prudence in terms of, who to lend to, who not to lend to?
No, absolutely, Asha. I think, again, the most important thing here is to first understand the customer. Yeah. So what we do see is today about 2/3 of our business in terms of value and 3/4 of our business in terms of volume come from beyond the top 10 cities. What we find is younger customers, and also customers who are more self-employed and non-salaried compared to in the larger cities. What we also find is aspirations are not very different, right? So if the aspirations are similar, age is different, customer profile in terms of occupation is different, income levels, of course, to start with are different. How do you bridge that gap? So that's where the solutioning comes in terms of what kind of products, what kind of underwriting and risk assessment is something that you can do. And from that perspective, clearly reimagining the current reinsurance or risk management framework is extremely important. Will we get access to the same kind of data? Answer is no. So can we make do with surrogate information which can help us make the same kind of assessment?
Like?
For example, today, let's say we have access to a lot of, if the customer consents, we have access to, say, income tax, GSTN portals, EPFO data, any of these portals, credit bureau information. Each of these will actually help you assess the broad standard of living of a customer, which will then feed into your understanding of the possible income of a person, the living conditions of that place in terms of medical infrastructure, digitization, etc. So from that perspective, if you're able to figure that into your thought process in terms of the front-end solution is one, but the back-end risk assessment and ability to have a process which is appropriate to that market is something that's very important. So that's where technology, data, and alternate sources of information become extremely important. What's also important is that the field force which is interacting with customers is educated to ask the right questions and to be the primary underwriter. So today we have about 38,000 odd people, more than 30,000 are in the field. They are the ones who are interacting with the customer for the first time. They need to understand what is it that is required for us to be able to offer solutions to them. The moment that culture kind of comes in, it becomes easier to, use technology centrally to be able to get to your models, to be able to throw up the answers that are required to go deeper into the market.
Mr. Jalan, it's not just about policyholders trusting the insurance companies, but it also works the other way around, right? Mr. Srinivas was saying that there's somewhere it's trust. You're also kind of trusting the policyholder. There is transparency. How do you build on to that?
When Srini was talking about, how accurately you are pricing the premium, one most important thing that we have seen, it is always extremely difficult to accurately price anything. If you are able to accurately price anything, you have done something wrong. You've definitely done something wrong. So you are trying to be nearly accurate, I would say. And when you are trying to calculate that premium, as an insurance company, we have to keep money aside to make sure that we are paying the policyholder at the time of contingent event happening. And that's the reason it becomes very, very important for the actuarial team who is preparing the liability which is the biggest component in the financial statement or the balance sheet, to be as accurate as possible as well. So with the current scenario, one, we are trying to see how accurately we are able to keep the liability aside. But as well as one thing Srini mentioned about the TMT test, where we are seeing that when policyholder is going, we are doing some underwriting processes. And different companies will have different rule around the underwriting processes. Some company might do the TMT test at maybe a CR cover. Some company might do at a higher coverage, or some company might do it at a lower sum assured. So now a couple of things that comes in the regulatory framework, which is very, very important. So I'll bring this again, RBC, where the companies which are keeping a strong underwriting process and having a very, very strong risk profile while they are giving the policy to a policyholder, they should be compensated for that particular thing. So that becomes very, very important. So RBC will come into the play, where your liability that you are calculating will be based on the risk profile that you are keeping, and also accordingly you will be benefited for that. And another thing that we have seen also, if you'll see in last 25 years, insurance is a complex business. It's a complex business, and life insurance becomes further complex, because we are talking about keeping the liability from the child is born, and suppose that child is alive for 100 years, we are making sure that our balance sheet is strong for that 100 year until the last policyholder come out of the book. So that's a trust policyholder is keeping it on the insurance company. From that perspective, it becomes more important that the liability is calculated at the right number, but as well as it is disclosed in a manner where all the stakeholders are able to understand it very well. because it's a complex business, it took many years for the people to understand the financial statement. Like, I have read a lot of financial statement before getting into the insurance space, and it was not an easy thing to understand the life insurance financial statement. It's a difficult thing. Now, industry started understanding, or the analysts started understanding it once the company started listing, when they have to analyze it. It took some time, but now with IFRS 17 coming up, that is going to be a further big change. And one example that always comes to my mind, globally, if you'll see, all the companies disclose their new business margin, and that's a good way, in a different metrics. Like US, you'll see it in the US GAAP basis, European market, you'll see in the Solvency II basis. In Asia, like Prudential, AIA, they report in TEV basis and in different scenario. And in India also, we have an Indian embedded value basis, but the companies that they're disclosing, we can see it in a consistent way, but all other companies, we don't know exactly what is happening. But IFRS 17 coming up, all of us will know what exactly other companies are doing. We'll be able to calculate it from their financial statement. We don't have to wait for the disclosures. From there, we will be able to analyze which company is doing, how profitable the business is, what's the cost of acquisition and everything. So disclosure is going to become very, very strong with the regulatory changes that is going to happen. Once those changes happen, the important thing will be for stakeholders to have more confidence in the industry as well.
Neeraj, how is it that you sort of see the risk discipline driving new product designs, new innovations, perhaps even tie-ups like Mr. Srinivas mentioned?
No, absolutely. I think what we've been just talking about and what Srini mentioned, I think the key is in terms of having access to as much information in whatever form possible to be able to go deeper. So now, if you were to think about the role of risk management and product innovation, I mean, I can think of a few examples that we've gone through in our journey. Let's say individuals buy protection by themselves. They also borrow to realize their aspirations for either a house or a car or any of their requirements. Lenders do a significant amount of due diligence at the time of providing a loan. That becomes a very good starting point because as such, it's very, very clear that the primary interaction is to take a loan to fulfill an aspiration. Insurance is incidental to that. Whenever insurance becomes incidental, it becomes a lot easier to assess that risk because of two reasons. One, it's in a group. Second, law of large numbers kind of take over. These are shorter duration contracts, easier to kind of assess the risk a lot quicker. So this is one of the few, one of the things that we had come out in the market many years ago, about 10 to 12 years back, where we started attaching insurance to group covers. A significant part of that is the MFI segment. So between each of these aspects, we are able to actually cover between 4 to 6 crore Indians every year. And that's something that has helped us actually get deeper using a product innovation lens. Second is in terms of, we talked about income variability becoming an issue, where let's say interest rate risk becomes one of the most important aspects to consider from an individual perspective, especially as India becomes larger and larger as an economy, interest rates are likely to tend downwards. When that happens, can I rely on, let's say, an instrument which resets a rate a year, every 2 years, every 3 years? Of course, it meets part of my requirement, but if one part of my corpus needs to have a more clear rationale of a guaranteed rate over a 20, 30-year period, how do you kind of construct that product? So that's where aspects such as risk management or through asset liability matching comes in as a very, very important aspect. And that's basically the foundation on which we were able to construct that product 4 years back, 5 years back, which has now become a very important product category for insurance. Beyond that, also in terms of things like a lot of customers do not like to think about protection on a standalone basis, because it's a lot easier to think about pleasant things. Pleasant things like, yeah, okay, I earn, I save, then I, reach, and I spend, right? But for that whole cycle to kind of continue, we are able to find a way in which we embed protection into the solution. And the rate at which the embedding is happening is only increasing now. So insurance products on the savings side typically have a cover which could be 5 times to 10 times what is paid as premium, but increasingly now customers are open to buying 20 times, 30 times, 40 times coverage. Again, starting with the principle of the primary objective being to create a corpus. And in case something goes wrong, this coverage comes in to step in from a family household perspective. So whether it's through embedded protection, through higher multiples, or through riders, some of the areas that Sri talked about in terms of not just death but also critical illnesses, these are things that kind of come in and into the consciousness of how some of these things become risk management tools, at the same time the fodder for innovation and helping customers realize their aspirations. So finally it all kind of connects from that perspective, and these are many ways in which some of these things are happening at scale on the ground.
Well, today's discussion clearly reinforced that risk management isn't just a safeguard. It's a strategic enabler. From balancing growth with prudence to leveraging technology and reinsurance to building trust through transparency, India's life insurance sector is preparing for a future that is both ambitious and resilient. A big thank you to our guests today, Mr. Vivek Jalan, Mr. Srinivas Rao, and Mr. Neeraj Shah for sharing their insights. And thank you for joining us on HDFC Life Presents live sessions partnered by ET Now. Until next time, stay informed, stay secure, and keep building towards a protected future.